Welcome, everybody. It's a great pleasure and honor for me to present my thesis advisor from University of Toulouse, Charles Rochet. He was teaching at University of Toulouse when I was having my PhD, and then he moved to Switzerland. Now he is a professor at Swiss Finance Institute of Banking at the University of Geneva and turned professor in the Toulouse School of Economics. He holds a PhD in mathematical economics from Paris University. He has taught at the Toulouse School of Economics, at the London School of Economics, and has visited many universities and central banks all over the world. He was the president of the Econometric Society in 2012 and has been a fellow of this society since 1995. He has published more than 80 articles in international scientific journals and 8 books, including Microeconomics of Banking with Xavier Freixas and Why Are There So Many Banking Crises. His research interests include banking, financial stability, industrial organization of financial markets and contract theory. Ayrıca Türkiye Bankalar Birliği'ne bu organizasyonu gerçekleştirebilmemiz için sağladığı destekten dolayı çok teşekkür ediyoruz. Floor is yours, sir.
Thank you, merhabalar, iyi akşamlar. Good evening. It's a great pleasure for me to be here, and many thanks to the Turkish Banking Association and Boğaziçi University for inviting me in what I think is the most beautiful campus all over the world. I've never seen such a beautiful university. So I'm particularly grateful to Professor Refik Arsen, Professor Burak Saltoglu, and also Professor Levent Yildiran for their wonderful hospitality. So I must confess I'm not a specialist of the Turkish banking system. So my presentation will focus on what I know, which is the European Union banking system. And in fact, my presentation will be based on current work I'm doing with Italian colleagues. And I hope that some of it might be interesting for you and for the Turkish banking system as well. As an introduction, let me remind you that the subprime crisis of 2007-2009 has forced many governments to inject a lot of public money into distressed banks. For example, US recovery at that time was only possible because the government, US government, injected more than $400 billion in what they called the Troubled Assets Recovery Program. In many EU countries, it turns out the recovery has been slower, and non-performing loans are still preoccupying. And in fact, this high level of non-performing loans may provoke underinvestment. So in my presentation today, I will start by reviewing the policy measures that have been implemented in the US and the European Union after the subprime crisis and for what followed in the European Union, namely the sovereign debt crisis. I will try to explain in particular the role of bad banks, and I will study in more detail one concrete case in Italy. And I will end by suggesting, and this is really the original part of my presentation based on this research paper that I'm working on, with my colleagues Bruno Parigi from Padova University and Marcella Lucchetta from Venice University. So it's for those of you who are interested, there is a discussion paper on which we are working, and I would be very happy to send it to you if you're interested. So basically in this paper, we try to suggest that a new form of bad banks, different from the one we are used to, would be easier to accept by bankers in general. So I hope that you can see in the back, there are too many things maybe on this slide, but basically it's a kind of summary of all the measures, the policy measures that have been undertaken in Europe and OECD countries in order to get rid of two problems that appeared after the crisis, which is the lack of confidence into the banks and the frozen credit market. So to be more specific, there were two problems. One was the lack of confidence on the part of the general public in banks, and this was restored by expanding and making more credible the deposit insurance for retail investors, for customers, retail depositors. And there was also a lack of confidence, or uncertainty at least, on the banks themselves about their peers, other banks. And so the government managed to guarantee wholesale borrowing, and the central banks had an important role in that. So here you have the list of the countries who have undertaken these measures: reinforcement of deposit insurance, for example, a guarantee of wholesale borrowings, for example. And on the second problem, which is the fact that the credit market froze, again, there were two different types of measures, one addressing the interbank markets, who more or less froze, or at least functioned less, although there is a controversy about that. I can come back to it if you're interested. And the way to restore the functioning of the interbank market was to, for the government to purchase assets or guarantee assets of the banks. And there was another problem, which was that the banks turned out to be undercapitalized after the losses they had suffered during the crisis, and also the governments injected bank capital or or subordinated debt. Okay, this is a list of the main recapitalization of banks that took place in Europe, mostly in the. I don't mention Switzerland, but it should have had. So as you can see, all the main countries of the European Union had to recapitalize their bank: Austria, Belgium, France, Germany, Greece, Ireland, Italy, Netherlands, Portugal, Spain. So it was really a generalized phenomenon. So there is an issue, which is when the government decides to recapitalize the banks, there are different ways to do that. And in another paper with my other colleagues, Hans Gersbach from ETH Zurich and Martin Scheffel from Mannheim, we try to provide something practical, a macro banking module that can be calibrated to real data. And this model can be used to optimize the public response to a banking crisis. And what we show in this paper is that a mix of publicly financed bank recapitalization and some dividend payout restrictions can, in fact, engineer a rapid buildup of bank equity, accelerate economic recovery, and decrease unemployment. So for those of you who are interested, this is the reference of the paper. But today I'm going to focus on a different thing, which is the type of interventions by the governments that have to do with the assets or the liabilities of the bank. So before I focus on the main topic, which is the assets, let me mention that governments also guaranteed the bonds issued by the banks. So these are the gross issuance volumes of government-guaranteed bonds in euro billion at the height of the crisis. And as you can see, several countries, in particular the US and also the European Union, issued or guaranteed, the government guaranteed a lot of bonds that were issued by the banks. Let me remind you of TARP in the US, which was the Troubled Asset Relief Program. And this was a program of the US government to purchase toxic assets and recapitalize troubled financial institutions. It was created by the Emergency Economic Stabilization Act of 2008, but it took 2 years, basically, for being taken into practice in the context of the Dodd-Frank Act that was signed in 2010, and which authorized expenditure or $475 billion. So in fact, the Congressional Budget Office estimated 1 year later that only 431 billion would be used, and the cost of the program for the net cost of the government, for the program for the government would be $24 billion. But in fact, it was a bit less than that. The program ended on December 19 of 2014, and it was found that the government had made a profit. It's a thing that you always see when there is government interventions on those banking crises. Most of the time, ex post, the government doesn't lose money. But of course, this is not necessarily an appropriate way to think of it in terms of the taxpayer, because ex ante, when the government intervenes, the risk exists, and it's not clear that the government will make a profit at, with probability 1, and there are countries in which this didn't happen. But it's true that in many countries, government seems to make a profit. Of course, if you adjust for inflation, this profit becomes a small loss. So let me focus now on the European Union. As I was saying in my introduction, non-performing loans are still a serious issue. And they affect not only Greece, as you can imagine, but also bigger countries like Italy, France, the UK, and Germany, even Germany. So the following figure plots the relative below the horizontal axis and the absolute above the axis amounts of non-performing loans in European countries in January of 2017. And as you can see, the amounts were enormous. So of course, in relative terms, loans, non-performing loans to gross loans, Greece is the most important country in the sense that almost half of the loans were non-performing. But if you think in terms of absolute amounts, what you can see is that Italy, France, Spain, and even the UK and Germany represent high volumes of non-performing loans. So in January of 2017, the average fraction of loans that were non-performing in the European Union was evaluated by the EBA to be a bit more than 5%. So the situation has improved. These are the latest figures given by the European Banking Agency, where you can see that the average rate of non-performing loans is a bit less than 5%, but still, it's important. And of course, there are countries in which it's still very big. So if you compare with Japan and the US, you see that the European situation is in between the two, in fact. This chart shows the ratio of non-performing loans compared to initial ratio when the crisis started in Japan, in the US, and in the European Union. So US are in green, Japan is in gray, and the European Union is in blue. So, of course, the crises were not simultaneous. For Japan, it started in 1993, and you can see that it took more than 50 years, or almost 50 years, to go back to normal. 15 years, 1-5. In the case of the US, where the peak was much higher than the other countries, where NPLs that multiplied by more than 3.5%, more than 3.5, 350%. It was faster to recover. In 8 years, they were back to normal. And probably because of the energetic behavior of the US government and TARP. In the European Union, where we didn't like something like TARP, and we are still like, well, 10 years after the crisis, you still have more than twice the level of the initial level of non-performing loans. So why is it a problem? Because non-performing loans may cause underinvestment. So this chart is not a proof of that. It shows only correlation, not causality, but still, it represents the growth, the net growth rate of lending to non-financial firms, the annual change in percent terms, in blue, and the rate of the fraction of non-performing loans. And what you can see is that there is almost a perfect negative correlations. When non-performing loans are very low, credit grows. When non-performing loans are very high, credit falls. Okay? So there is a literature in financial economics trying to explain why a high fraction of non-performing loans generates underinvestment. And the main reason that is attributed to this by a financial economist is the so-called debt overhang problem. So I will not go into the technical details, but roughly the idea is that when a bank has too many non-performing loans, or more generally too little capital, shareholder value can be reduced, and this is a paradox, by making new loans, even if these new loans have a positive net present value. So if you have good customers with good project, it may turn out that shareholders lose after those new loans, simply because the benefits from the loans essentially go to the debt holders and not to the shareholders. So it means that banks may be very reluctant to lend. Of course, there is other explanation, which is a notion of asset contamination, and which has to do that bankers have more information than outside investors and also regulators about the quality of their assets portfolio. They know better. And so this is what we call in economics an adverse selection problem. If you want to refinance yourself, you will have more difficulties because investors do not know exactly the quality of your assets. And similarly, the regulators, when they want to organize a bad bank, let's say, well, they don't know exactly the price they will have to pay for the bad assets. Okay? So what happens is that bankers often oppose rescue plans unless they are very favorable to them. And in this case, unfavorable to the taxpayer. So what are the possible solutions to this non-performing loans problem? Well, I already reviewed the general policies that can be done. In this case, recapitalization, government guarantees of bank liabilities, asset purchases program. Of course, this solution can also work, not only for a big crisis, but also for a period of underinvestment and credit crunches. But I will concentrate on the most interesting part for this talk, which is the creation of a bad bank. You know, in other words, removal of the non-performing loans from the bank balance sheet and creation of a bad bank. So if you Google bad bank, this is what you find. It's a Netflix series. And as you can see, 3/4 of the bankers are men, and they're all focused on the only female banker. And the female banker is the only one to look at the customer, at the interest of you and I. Seriously, a bad bank is a corporate, but I recommend this series, by the way. It's I don't know if you have it here in Turkey, but it's very nice, very funny. Anyway, bad banks are corporate structures designed to isolate the high-risk assets held by a bank. And most of the time, they are organized and funded by public authorities. And it's called the centralized public asset management company. And in many cases, private banks are reluctant, as I said, to participate, unless the terms, which is basically the price at which the bad assets will be bought by the government, is very, very good, very favorable. So what we suggest in this paper is an alternative way to organize this separation of assets, and in a way that banks' participation is easier to obtain. In some sense, it's a kind of private solution to the non-performing loan problem. So what are the pros and cons of a public centralized asset management companies, where basically you take all the bad assets of the banks and you put them into one company funded and controlled by the government? Well, there are economies of scale, clearly, because you do that for all the banks that have toxic assets, and you don't have to repeat it for each particular bank, which is a good idea. You also have the centralization of collateral, and this can facilitate securitization of assets. You can benefit from some degree of diversification, and also it allows banks to focus on core business, which is to deal with good loans, with good borrowers, and forget about the bad asset, toxic assets. But there are also cons of this public centralized asset management company. As I said already, banks may be reluctant to participate. Sometimes they would lose, so they will try to underestimate the extent of the non-performing loan problems. So unless the terms of the deal are very favorable to them, they will be reluctant. And this has to do with the fact that banks have better information about the quality of their assets than outside investors, but also than public authorities. And there is another problem which is a bit delicate, but which concerns all countries, I believe, which is the fact that if you have a public agency that takes care of these bad loans, then it may be subject to political pressure. So you can have, in both directions, you can have favoritism to some of the banks, or you can have forbearance, where the supervisor don't want to recognize that they have not done their jobs properly, and they try to, avoid the problem. So, in a very interesting paper, Daniela Klingebiel from the IMF has studied 7 banking crises of the 20th century, of last century. Finland in 91, Spain in 78, Sweden in 91, US in 84, Ghana in 82, Mexico in 84, Philippines in 85. So this represents the fraction of the assets that were transferred to these public centralized asset management companies. So in blue, it's the proportion of the total assets of the financial system. In pink, or in purple, it's as a proportion of GDP of the country. So as you can see, this can be very high. For example, in the case of Philippines, it's around 20%. That's huge. In other countries, it was less important than that. But the important thing is to see the impact. So first of all, the cost, the magnitude of the crisis and the cost of the resolution. So the charts represent here in pink, in purple, the total assets of the banking system, the size of the banking system, if you like, as compared with GDP. So you see, for example, in Sweden, it was very big. And in the 2 other bars correspond to the resolution cost. So there is always a controversy among economists on the way to measure the cost of resolution of a crisis, because you have the fiscal cost, which is the amount of money that was injected by the government. But in fact, ex post, most of the time, it's a profit, they make a profit. So it's more interesting, I believe, to try to measure the impact on GDP, but this is much more complicated. Anyway, so this shows that there were countries in which it was not a big deal, but there were countries in which Mexico, Finland, Philippines, and even Sweden, where this was much higher. So the most important table is this one, where Daniela Klingebiel has computed the impact of the creation of the asset management company on GDP growth and credit growth in the different countries. Well, this is the year where the asset management company was established. This is the growth rate of the economy before, during the crisis, and after, and 2 years after. And the same for credit growth. And as you can see, they were not equally successful. There were countries in which it worked quite well. For example, in Finland, in Ghana, in terms of growth rate of GDP, or in terms of the growth of credit, spectacular figures. But there are other countries like Sweden and USA where apparently it was not so successful because 2 years after there was still credit going down. Okay? So it has to, I mean, the paper is interesting, even though it's already old, because it analyzes the reasons why it worked more in some countries than others. Okay, so I will focus on the more recent period, 2008-2014 in the European Union. So to give you an idea of the number of asset management companies that were created in the EU countries, you can see that it was quite important. You know, there were countries in which there was only one, like Denmark, for example. Denmark, they pooled all the banks and created only one asset management company. There were countries like Austria or Portugal where there were several. And interestingly, and this is a recent paper by Gandhold and Hallerberg that shows that, you can distinguish 3 distinct phases for this, the way in which those asset management companies were organized. Initially, during the height of the crisis, 2008 to the mid-2009, bad banks were completely controlled by the state. In particular, in Germany, there was these big problems with the local banks, with the Landbanken and the Hypo real estate. So the government took care of everything, organizing the thing, putting money. The private banks had nothing to say. However, in July of 2009, Eurostat, which is the official institution that accounts for the statistics and the accounting in European Union, they decided to count government participation as public debt. Okay, so it had a big impact on the level of public debt. And so the governments decided to adjust their strategy. So gradually, in the period from 2009 to mid-14, the governments decided to continue controlling, try to control the bad banks, but to stimulate private ownership as much as they could. And finally, the last stage, the last period where we are in actually, since there was this bail-in regulation, the so-called BBRD, I will come back to it in a minute, it turned out that completely private bad banks were organized. That is, the government was not supposed to inject any money in those bad banks. So how does it work? There is this directive from the European Union, the Bank Resolution and Recovery Directive, that recommends the use of bail-in plans. So the notion of bail-in is very important because it's a way to get rid of the too-big-to-fail problem. Instead of saying every time there is a crisis, the government is supposed to recapitalize the banks, here the idea is to say that the banks themselves are supposed to provision ex ante possible losses that they may occur if they are about to be liquidated. And one instrument is the famous COCO bonds, that is contingent convertible bonds, where bonds are converted into equity or written down when there is a liquidation process. And the idea is that no public money, no government money has to be used. Okay? So it took some time to phase in this BRRD, but it's changed the framework for the creation of bad banks. So let me give you an example for 4 Italian regional banks in November 2015, a Sunday, like always. The banks are always closed on Sundays. So the government decided to close down 4 regional banks, Casa Risparmio Ferrara, Banca Marche, Banca Popolare dell'Etruria e Lazio, e Cassa Risparmio Chieti. They were small banks, and they only represented 1% of the assets, total assets of Italian banks, but still there was a political dimension to it. And the reason was mounting losses and increasing number of NPLs. So how did it happen? Well, all the toxic assets of those banks were put into one bad bank or one asset management company. And the values of those loans was written down for 8.5 billion euros to 1.5 billion. So it's quite a big reduction. They were all placed in the bad bank that was funded by the banking industry. The banking industry contributed to 140 million in the form of loans, credit lines, and equity. And the bad bank didn't have any banking license. It was only there to manage and sell the non-performing loans. It was not allowed to attract deposits, for example. So the four banks became good banks. And they did that by changing their names. They are Nuova, the new bank. Okay, so it is the same bank, but it's called Nuova Bank. So now it becomes Good Bank. So it kept the deposits of all the original banks and the good assets, and they were recapitalized by the resolution fund. So what is the resolution fund? Is a tool of the directive, the BRRD directive, and actually it was ratified by Italy 1 week before. So it was a good timing. And it was not considered to be any state aid, in the sense that it was financed by bailing in of shareholders. The shareholder lost money, subordinated debt holder. And of course, there was new equity injected in the system. So roughly, the resolution fund spent about 3.6 billion euros, 1.7 to cover original losses of the four banks, 1.8 to recapitalize the good banks, 140 million to recapitalize the bad bank. The capital of the four original banks were wiped out. That is, the 130,000 shareholders lost everything. Among them were foundations, so it has some political, impact. And 10,000 subordinated bondholders suffer 750 million losses. There were other examples in Italy that worked less well, because the banks had managed to sell their subordinated debt or their equity to retail investor, retail depositor that did not understand anything of what they were buying, and that kind of a political clout. So the government could not do that in the same way. So let me try to clarify how these kind of bad banks work and what's the difference between the publicly organized bad bank or asset management company and the privately organized asset management company. And I will do that by a fictitious example because I don't want to bore you with the details. So suppose you have this fictitious bank that has a balance sheet of 100. I don't know the units, but let's say 100. You have risky loans, 10 of risky loans, 80 of safe loans, and 10 of securities. You have 75 of retail deposits, 20 of bonds, and 5 of equity. And suppose that you learn that risky loans are in fact only worth 5. That is, among them, there are not non-performing loans, and the true value is not 10, as you thought, but only 5. So if you do nothing, since the value of the other items of the balance sheet do not change, it's the equity that is severely reduced in this case. So you have to do something, because the bank does not satisfy the minimum capital requirements and is not viable like that. So what can you do? Well, a classical way to organize that is to have a publicly organized bank split. So here, the bad banks is created and is controlled by the government, and it buys the bad loans from the good bank at a price of 5, and this is financed by issuing a new bond. So the bad bank is able to issue a new bond, but it cannot issue the full value. So the government has to step in order to recapitalize the bad bank. So the government owns the bad bank, the government injected capital into the bad bank, and the new bank or the good bank can start lending again. So the new bank, who has the safe legacy loans and the securities, is now able to lend again to new businesses. And so how is it financed? The new loans, they are financed by new equity issuance, and by a transfer from the bad bank. Remember that the bad bank buys the bad assets to the good bank for a price of 5. So the interesting thing is that the initial shareholders, the ones that were in control of the bank before the split, they are wiped out. They get nothing. So they are not very happy. Since they are the only ones who have the information about the true quality of the assets, you can imagine that they will use all the possible means to oppose that. You will say, oh, no, but you have overestimated the size of the problem, blah, blah, blah. So what we propose is an alternative program where bank shareholders do not lose anything. So how does it work? So remember, you start by this balance sheet, but there is a difference here, which is that among the bonds, 1/4 are bail-inable. What does it mean, bail-inable? It means that they can be written down, or alternatively converted into equity, like CoCo bonds, but here they can be written down in the case of a split. Okay? So suppose, like before, that the risky loans appear to only, the value is only 5 instead of 10. You learn that, bad news about your risky loans. So you're going to split the banks by putting the bad assets, the bad loans, into one bad bank, but it will be different from the organization we had before. It's not the government that is going to control the bad bank, it's the shareholder, the bankers themselves, who are still owning the bad bank. And instead of issuing new debt, the bad bank will just write down the bail-inable, the legacy bond, to 4 instead of 5, the bail-inable bond, so they are only worth 4. Which means that the equity of the bad bank is still positive without having to inject new funds. So, if you like, the difference is that the bad bank takes not only the bad loans, but also the bail-inable debt, part of the debt, which allows to reduce the debt of the good bank. So the good bank is in a position then to issue new debt and to issue new equity. So the shareholders are not wiped out. They keep the control of the bad bank. And the good bank is able to issue new equity and new bonds and finance the new loans. So it's, of course, a very simplistic example, but in the paper we explain in more detail how this can be done. So in other words, the main difference is that you don't need any government intervention, you don't need any government money, you don't need any transfer from the bad bank to the good bank. You only need the possibility to bail in the debt, some of the debt holders. Okay? And the good thing is that the shareholders remain the owners of the bad bank, and they are not wiped out, and they have no reason to, if it's well designed, they have no reason to hide the extent of the non-performing loans. So in the terminology of contract theory, the mechanism is incentive compatible, right? Okay, so let me conclude. I don't know how I'm doing with time. Maybe it's a bit early, but let me conclude by saying that non-performing loans are still a problem in many EU countries, and we believe that they do contribute to the underinvestment problem that we see in the European Union in many countries. And so the usual solution would have been for the governments to put all the bad assets into a subsidized bad bank. However, this kind of plan will be opposed by banks who will try to underestimate the size of the non-performing loan problem. So we believe it's important to adopt a new style of bad banks that is under the control of the private sector and that does not suffer from this incentive compatibility problem. So banks have a better information than the government on the exact value of their asset portfolios. Their voluntary participation is a necessary condition for the success of a bad bank. And thus, a bad bank program can only work if the banks, the commercial banks, do not lose from it. And this is the type of thing that we propose. And if you're interested, I can send you the full paper. Thank you very much for your attention.